Hello, everybody. Welcome to our next episode of the Stock Talk Show. I'm Chris Tolson. Joined with me, as always, is my technical counterpart, Nick Chin. Nick, how you doing?
What is up, Chris? Ready to record our first show of 2016.
Yeah, it's going to be a good one. This week, we've got on deck for you what we consider the best stocks of 2016. Basically, we've compiled a list of stocks and their industries that we think are going to have the best gains for this upcoming year. We break them down fundamentally and technically.
Yeah, quick disclaimer as always, guys. This show is purely for entertainment. Don't just take our word for it. Consult your financial advisor. Do your own research before you decide to make any of these trades.
So first on the list is Valero Energy, ticker VLO. They're right now trading at $66.25 a share. We've talked about them on the show before, so I won't get into sort of the nitty-gritties of the company, but they're basically in the oil and gas and consumable fuel industry. They manufacture and refine petroleum products. I like the industry as a whole right now. I think it's undervalued. With Valero, it has a PE trailing 12 months of 6.85 times earnings, which is below the industry median of 10.36. They've got a 3% dividend, which I like to see in companies. They're using their cash well. They're still trading high in their 52-week range, which is the 52-week high of $73.88 a share. So I think they've stayed strong during this recent market crash and oil crash as well. I like them. I like what they're doing. PEG of 1.20. So I think they've got some serious upside for this upcoming year.
Yeah, they had a very strong end of 2015. They stayed in a nice uptrend, but it did break that trend December 11th as the market did start pulling back. But it barely broke below it, and I like that because it remained very stable these past few weeks as the S&P and the rest of the market has just kind of tumbled. Like Chris was saying before, Valero is a very strong stock, a very strong company. Right now, it's not an immediate buy. I would wait for it to break above $69 a share before you consider it, because there is major resistance at that point. I think the buys will start really flooding in once it gets to that point in the chart, though. So look to around $69 a share and buying the breakout if it does get to that point. An intermediate price target, if you do decide to do that, would be around $75 a share. But my price target for the entire year, I would say, is $80 a share.
Yeah, I see Valero kicking it up to $80 a share by the end of the year. And also, other plays in the industry that I like right now are Marathon Petroleum Company, ticker MPC, Tesoro, ticker TSO, and Phillips 66, ticker PSX. So if you're not really a big fan of Valero, you can look at these other companies in the industry that I also expect to grow.
Yeah, for the next one, let's do Delta. It's DAL, currently trading at $46.15 a share. Delta did come down to the rest of the market as well, but is hovering around pretty big support at around $46 a share. It's failed a few times to break above $47 a share, which is also another pretty big major level of resistance that it formed back last year. I would wait a little bit on Delta as well, but once it breaks above the 47-48 level, I'd look to get in on the breakout. And this is pretty dependent on what the rest of the industry does and what the S&P will do as well, because it seems to follow that index pretty hard. So I'd look to either get in on the breakout from $48 a share, or wait for that to form an uptrend. If it does decide to break above that level, I could see it pulling back to around $47 a share, which is that big level, and for an intermediate buy, coming up to around $52 a share, which it has tried doing two times at the end of last year. So it seems like there is really big resistance there. I do think that it will break above that for the end of the year, and I could see a price target around $58 a share by the end of the year. Chris?
Yeah, I like Delta. I like the airline industry as a whole, but I specifically like Delta right now. They've got a PE of 8.15, trailing 12 months times earnings, which is below the industry median of 10.2. They've got a PEG of 0.35, below the industry median of 0.43. So I think they're inexpensive right now, just based on these fundamental metrics. They've got a dividend of 1.18%, which I think will increase over the year as their margins increase. Operating costs are down, of course, with oil being so cheap right now. They're locking up contracts for oil. They expect, in their quarter 3 earnings, they said they expect the margins to have a 10-point improvement, basically because of these low oil costs. They also reported their passenger miles are up, increasing their passenger load factor, which is at 85.2%, very high. I like that number. So I expect them to have more cash on hand, which will increase their dividend. And I really like them as a whole. I could see them reaching $65 a share by the end of the year. Other plays in the industry, if you're not a big fan of Delta, Alaskan Airlines, ticker ALK, JetBlue, ticker JBLU, and American Airlines, ticker AAL.
All right, for the next one, let's do Walmart. And the ticker is WMT, and they're currently trading at $63.52 a share. Walmart has been my favorite stock over the past month, ever since the start of the new year. As the market was tumbling downward, Walmart was the one stock that remained strong. It was the one stock on the Dow 30 that showed daily gains every day. The rest of the market was down. So one big thing I noticed was back in at the end of 2015, it seemed to be doing a pennant, which is pretty much just a triangle. And after it broke through that trend, Walmart has been rallying upward. It formed a higher high back in early 2016. I think it was the 3rd or the 4th, January 3rd or the 4th. It pulled back, and the buy point was around $62 a share. Right now, I could see, if you want to buy Walmart now, there's a good $3 gain that I could see it easily making it to around $67 a share. So that's a good intermediate price target as it approaches pretty big resistance at around $66 a share. But for a price target of the year, I could see Walmart coming up to $70 a share. It has had a few rough patchy years recently, but I think Walmart's really starting to gain some momentum right now, and I'm pretty bullish on Walmart.
Yeah, I am too. Their growth isn't like what we used to see in Walmart. It's not where it used to be, but they're still undervalued right now. PE of 13.6, so it's pretty cheap. I like Walmart. They've got a good dividend. You can stick your money in there and just let it grow over time. I think that's what a lot of people are doing with this stock. There's not much percent institution. So I do see Walmart. I like the play here. I can see it raising to $70 a share by the end of the year. But another stock that I like in the food staples and retailing industry is CVS, ticker CVS, of course. They trade at $94 a share. They're a bit more overvalued at a PE of 21 times earnings, but they trade at the bottom of their 52-week high, which is 113. They're generating cash. They're increasing their revenues. And their 2016 outlook is pretty good. I like what the company's doing to grow that stock. I could see them easily hitting 120 by the end of the year.
All right, so the next one we're going to start on is we're going to do Discover Financial and Capital One. I do like Discover. They follow the S&P pretty hard. Again, it was another stock that came down pretty hard to the rest of the market, breaking through pretty big support around $50 a share. I would wait a little bit again for this one if you're looking to get into Discover. If it does break above $50 a share as the S&P looks to recover, that's a pretty good point to buy the breakout. For an intermediate term buy, I could see it coming up to around $56 a share, where it did do that W formation in mid-December. One thing I must say about Discover, though, is when it did break that formation back in mid-December, that was actually a pretty good short. It's like a textbook short. But as that's ended, right now I do think that Discover is pretty undervalued. Like I was saying, a good price target, if it does break above $50 a share, I could see it coming back up to around 56 to 58, and for the year around 60 to 62.
Yeah, I like both of these stocks. I like the consumer finance industry as a whole. I think there's a lot of potential to grow here. We've got an increasing prime rate, which follows the federal funds rate, increase in disposable income of people, increase in consumer spending, increase in use of credit cards, increase in e-commerce sales, which is where you're going to see use of credit cards up, as you can't use cash buying stuff online, which you could, but you can't. So I like the industry. I think it's going to grow here. And both these stocks are pretty undervalued. Discover has a PE of 9.8 times earnings, and Capital One a PE of 8.4 times earnings. I like the stocks. I like Discover a little bit more. It's got a return on equity of 22%, which is a lot higher than the industry. It's near the bottom of its 52-week range, and it's got a pretty low charge-off rate, so that they're getting their money back. And I really like their growth right here. They're third largest student loan provider and fourth largest credit card. So they're doing well in that industry, in both industries, and the stock or the industry as a whole is going to grow. So I see the stock growing as well.
Like Chris, though, I do like Discover a little bit more than Capital One. But if you're looking to get into Capital One, it's a very similar play. I would wait for it to come back up to around $70 to $75 a share first before you look to get in. Maybe good earnings will help spark some momentum into that stock. But right now, wait for that price to come up a little bit more before you get in and buy that breakout and the rebound with the rest of the market.
Yeah, be looking out for Discover Financial's earnings. I think they come out on February 2nd. I expect them to have a year-end price of $65 a share, and I expect Capital One to have a year-end of $75 a share.
Capital One, my end-of-year target, I could see it coming to around $80 a share.
So, next on the list, we've got Gilead Sciences. It's a stock that we've talked about, I believe, in the first episode of the show. It's a stock that I own, so I won't try to shove it down your throats too much. It's a play that I like. They've got a PE of 8 times earnings, so they're cheap. I'm not going to try to get into the pipeline and growth, but I really like their pipeline and growth.
Yeah, it's one thing I've heard enough of Gilead Sciences, but
yeah,
I do like.
I don't want to talk about it too much, just because of conflict of interest. So Nick, you go ahead and say what you want.
Gilead Sciences was something that really followed the S&P pretty hard as well. It came off pretty big support around $90 a share, and it seems to be facing some more around $95. Another stock that I'd wait to see it break above that point before you get in. Actually, at the end of 2015, it was downtrending pretty hard, but each consecutive low has been a little bit smaller than the past one, which is a very good sign. It means that the shorts are starting to cover more. So with Gilead Sciences right now, I would wait for it to come up or break above $95 a share and buy that breakout. Because like Chris is saying, I do think it's an undervalued stock, and I see an intermediate price target of around $110 a share, and for the year, I could see this thing coming back up to $120. I like Gilead Sciences a lot for this year.
I see it at $120 by the end of the year. Just mainly off their growth, and they are the strongest biotech company that's in the industry. Next up, though, we've got Mylan Pharmaceuticals, ticker MYL. They're trading at $53.83 a share. They're, like I said, a pharmaceutical industry. PE trailing 12 month at 30 times earnings, which is sort of high when you look at it, but it is a bit below some of the other large names in the pharma industry. They're a company that produces active pharmaceutical ingredients. So the demand for that won't really go down over time as they supply other drug companies, other chemical manufacturers. Their revenue growth is trailing 12 months is up 21%, outpacing the industry, which I like. Discounted price to sales. Their PEG, it's in line with the industry median, but I really do like the stock. They're trading sort of in the middle of their 52-week range, 52-week high of $76 a share. So I do think that they're gonna come up to that by the end of the year, and I do like their growth.
Yeah, it's funny as a technical trader when you look at Mylan Pharmaceutical. Obviously, they're not like Walmart, but their charts are very similar. As the S&P was pulling back, Mylan remained very strong, and the buy point, like Walmart, was at a similar time. Like I was saying before, remained very strong and pulled back to major support and didn't break through it at around $50 a share, which was a pretty good buy. Right now, it's coming up to pretty big resistances as well at around $55 a share, and I think two things could happen here. Either Mylan wants to stay in a range and from 50 and 55 and possibly form a W and rally from there, or if the S&P shows strength these next few days, if it breaks above $55 a share, that's definitely a good buy point because of the major resistance at that point. For an intermediate buy, watch this one closely. If it does break above 55, I could see a good $5 return on this stock. If it does trade in a range, it's a very day tradable range to do so. But like I was saying, just keep your eye on that chart and the stochastic as it's starting to top out now. So just see how it reacts with the rest of the market.
Other stocks that I like in this industry are Allergen, ticker AGN, and Lanet Company, ticker LCI. I think Lanet Company is a bit more of a risky play, but I do think that it's got potential to go up for the year. Next up, though, we've got Google or Alphabet Inc., ticker GOOGL. Nick, you want to talk about that a little bit?
Yeah, so Google right now is trading around $729 a share. It's always been a very strong stock. And although some people think it's very overvalued as a stock price, they just continue to grow. Google is another one of those stocks that was very strong as the market pulled back. So it's one of those, as the market looks to rebound, I would also look to get in the intermediate term, because each ticker for Google is so large because of how volatile and how high the stock trades. I could see this thing coming up to around $800 a share in the intermediate term, as it approaches. Actually, as it looks like right now, as it wants to break through some big resistance that it's facing. It's pulled back a little bit this past day, but today it was indicative of an update tomorrow because of what they call a hammer, which it pulled back and came all the way back up. And when you end that usually means buyers are starting to flood in. So this is one that I would watch in the next few days, and if it does break above that $750 level, like I was saying before, this is a good buy. And I could see a price target for the end of the year around $850 a share.
Yeah, I like Google. I like Alphabet.
Alphabet.
Whatever we call them now. They've got good branding. Like even though we are messing their name up, Google is everywhere. They're involved in all different types of things. They're finding new revenue streams, so I think they've got a lot of potential to grow as they find these new revenue streams, find new ways to make money as they spread their name and sort of gain more income. So I do like them. Price target at the end of the year is of $825.
Yeah, so for the last one, we're going to do some of it was Mondelez. And Chris, what...
food products industry.
Yep. See, as a technical trader, I don't even know what that what that is.
Yeah.
But Mondelez right now, I think it's an undervalued stock. It did come down to the rest of the market, like a lot of the other stocks I'd mentioned before, but it has been strong these past few days. It's currently trading at 41.35, and sorry, the ticker is MDLZ. Today was a good sign for Mondelez. It did come up above major resistance that it formed back in late September. And now that's done that, I could see this thing rallying back up to $43 a share. And for a year or end of the year target, I could see Mondelez coming up to around $50 a share. It's one of those companies right now that has been stuck in a range for the end of 2015 at least. And I could see it doing that again for the earlier part of the year. But like I had mentioned before, if it does break above that range, that'd be huge for Mondelez stock. And if it does that, who knows how high the stock could go. But right now, it's one of those ones that you just have to watch pretty closely. If it does, like I was saying before, if it does break above 41, I would buy that breakout, and a price target to get out would be around $48 a share for an intermediate trade. So
I like this stock. It's probably my favorite stock for this year. I think it's grossly undervalued. It's got a PE of 7.7 times earnings. I think that it was spun off of the Kraft acquisition, so I think it's got a lot of room to climb for this year. I think it can climb up to 15 times earnings, where I have a price target of $65 a share. I think it's probably my favorite stock of this year, and there really isn't much else to say about it. It's undervalued.
All right, so those are the those are the stocks that we think are going to do well in this upcoming year. But some things I have to say about the market right now. Even though we've had a few nice recovery days in the market, ever since we had that big crash from economic news from China and the big drop in oil, I wouldn't say we're out of the woods just yet. Be very wary of the market, just because of how dependent it has been on oil. But one thing I must mention as well, earnings week is upon us, and that could help turn the tide for the market. And as we have come down to pretty big support, at around 1870 for the S&P, if the earnings do come out good and pretty positive overall this week, I could see the S&P rallying all the way back up above $2,000. So it's just something you have to watch, especially with earnings coming out and how volatile the market's been. But for this upcoming year, I do think, like we're saying before, those stocks that we had mentioned have been performing well recently, and I could see that trend continuing throughout the year.
Yeah, I'm pretty sure that portfolio that we just gave out to you, that'll probably get like gains of 1,000% for this year.
I think 2,000.
I do like the market for this upcoming year. I think the S&P will definitely reach over 1950. One thing we do have to look out for is the appreciation of the U.S. dollar and see how that affects the economy. Also, the Fed raising rates even further throughout the year. But I do like the stock market for this year. I think it's going to recover.
Yeah, and one more thing as well. When you have a big crash like we did before, one thing you should always look for in stocks are stocks that perform well when you do it. And that's just my perspective, because other people think that you look for stocks that have pulled back a lot and you get a better value for it. But when stocks trade well and they seem to be going up when the market's going down, it means that investors see something in the stock that others don't. They see the potential in it, and they want to start the trend early before the market decides to turn around. So that's one big thing you should look for. And when you have these big times of volatility like this, one big saying that I've heard is that it's not necessarily always time to invest, but to trade for more intermediate plays. And that means holding your position for a few days rather than a long period of time. That's one thing that a lot of people have said to do when the market becomes very volatile, like it's been the past few days. Chris,
all right, so no, I think that's it for this episode. Looks like we missed out on the 20-minute mark. Just went over that by a minute. But
don't let that deter you, though.
Yeah, but best of luck in the market for this upcoming year. Thanks for listening, guys. I hope you tune in for our next show.